welcome to the CNBC TV 18 special. We're coming to you live from New York, and we're in conversation with two of our domestic fund managers, top fund managers, to talk about whether there is a convergence between how FIIs view India and how domestic investors are now looking at India. Naganath and Sunil Singhania, appreciate you joining us here today. Let me start by asking you, Nag, what's the mood like? And everybody's talked about sentiment being better and so on and so forth. But let's just look at what's happened over the last couple of days, because there seems to be a little bit of trepidation with how much steam there is actually left now and whether we're done for now. The worst series that we've seen in the last 8 months, the rupee is depreciating once again. FIs have started to pull back. Is it looking good for a pullback at this point in time, or do you believe that the rally has more legs?
As far as institutional investors internationally are concerned, there's a lot of interest in India. And this extends to institutional investors like pension funds, insurance companies, family offices, endowments. All of them see India's growth accelerating over the next 2 or 3 years. And in fact, growth of 5.8% or so, which is expected this year, the general expectation is that it will move up much further in the next 2 or 3 fiscal years. Our own view is we will get to see 7% GDP growth rate in fiscal 16 and 17 and beyond. And so all of that, I think, will underpin strong growth in corporate earnings and therefore strong performance in equities. As far as fixed income investors are concerned, the expectations are that as inflation begins to recede, and it is beginning to recede, you will probably see some rate cuts that will happen, in our opinion, again in early next year. And so that again will underpin strong performance in fixed income. So both domestic investors and foreign institutional investors, we think, are very optimistic about the prospects for both equities as well as fixed income.
Sunil, no one's arguing about the long-term trend as far as the Indian equity market is concerned, and it continues to look strong. The bullish sentiment continues with regards to the India story at this point in time. But over the next few months, and especially, people putting out Sensex targets of 30,000 by the year end, do you believe that we're still on track to be able to meet those targets, or do you think that we are going to see at least a 5 to 10% pullback from these levels?
See very clearly what has happened, particularly in the last few days or weeks, is that there was definitely one category of markets which was going into euphoric zone. When you start to get tips every day of 10, 15, 20 stocks, and the stocks hit 20, 30% circuit, that is the time when you know that you have to be cautious. So I think what we are seeing now is basically a pullback in those category of stocks. Obviously, the Supreme Court judgment on the coal issue has caused some challenges. But if you go back, similar kind of challenges were there when the spectrum issue sort of blew over. And after that, that segment has completely become very, very transparent. So we believe that there is going to be some challenges. Obviously, the oil price, the gas price delay
which is being deferred,
also has added to some extent of uncertainty. But most, the markets were ripe for a small correction that we have already seen.
So you anticipate only a small correction? You don't think this is going to be a deep, long-drawn correction?
It does not seem to be the case because there is no sign of general widespread euphoria or overvaluation. Yes, we are not cheap, but at 16 times current year earnings, and if you just move a couple of years ahead, we are at like 11.5, 12 times. We are nowhere in the region where we are topping out. So there is definitely,
because there is one camp that believes that valuations are looking stretched at this point in time, and there's another saying that look at the opportunity that India can enjoy, and then look at valuations in that context.
I think again to focus on the near-term correction. Given the rapid rise in equity prices the last few months, some correction was expected. Our own view is it will be a mild correction, 5 to 10% at the most, before we resume the uptrend. So that's the first point. As far as the weakness that we've seen in the rupee recently, that's because the dollar has been strengthening. And it's not just across. I think if you look at the yen, you look at the euro, so this is not specific to the rupee per se. As far as the medium-term outlook is concerned, like I said, investors are looking at a 3 to 5 year outlook for Indian equities, and the outlook looks bright.
So you're sticking with the Nifty doubling by 2017, which is what your target was?
Yes, I still think that once this correction is done, we should expect, in my opinion, I would rather give a very high probability to the Nifty or the bellwether indices doubling over the next 3 years or so. And I think any correction ought to be looked at by investors as a good buying opportunity. And as far as valuations are concerned, we've had a significant expansion in the PE multiple. That's an anticipation of the growth coming through. Now, the question is, how confident are you of that growth coming through? I'm very confident that we will see GDP growth at 7% or better in fiscal 16 and 17. And at that point in time, the focus will turn to earnings growth. So even though Ps look a little higher than where they were a year ago, the fact is that earnings growth will come through, in my opinion, next year and the year thereafter.
Given the fact that you're confident about earnings growth, you're confident about the turnaround that the economy is seeing, and you believe that this correction should be used as an opportunity to get into the market, what is it that you would like to buy at this point in time?
There's enough choice of sectors in India. That's what makes the market very interesting, and choice of companies in terms of capitalization is also enormous. But specifically, I think banks and financial services, which have a high weightage in the index, typically do better when the economy is in the uptrend. So we think that's one sector that is large and will continue to do well when the economic growth momentum is accelerating. The second sector to look at would be the entire infrastructure, capital goods, engineering sector, because of the revival of the capex cycle, the investment spending cycle. And then, of course, you've got sectors like auto, which are seeing a revival in demand compared to where we were 2 years ago. The oil and gas, the energy sector, the utilities sector, not to forget pharma and IT, software, because, growth there continues to remain quite strong. So I think we have a fairly good choice of sectors to invest in.
What about you, Sunil? What are the sectors that, do they look exactly like what Naganath has just pointed out?
I agree with Naganath that India is a very interesting economy in the sense that, you have almost presence in all sectors. And you have small companies, mid-sized companies, large companies. And the good thing is that a fair bunch of these companies have very good corporate governance standards. So I think it's become much more, you can say, easier for asset managers, because you're convinced that at least on the corporate governance side, there are a lot of companies which are there. I would agree on the financials side, but our weightage is more towards the private banks. We believe that, yes, public sector banks have become cheap, but there might be a little bit more stress, predominantly emanating from...
On account of things like coal and...
Yeah, right. So, you'll have some issues there. We continue to be positive on IT and pharma. We do believe that, the valuations are fair, considering their growth and stability of earnings. Rupee at 60-61 is a great thing for export-oriented sectors, and they should do well. And I think on the capex side, though we would agree with Naganath, our view would be that just be concentrated on companies which have decent balance sheets.
So you don't believe that valuations are stretched on the mid-cap side at this point in time?
Selectively, there are opportunities. Even on the large cap, IT sector, for example, is trading at a discount to the overall market sector. And just because everyone post elections wanted to move towards so-called, the capex sector, I think the IT sector underperformed for those 2-3 months, but it's now coming back.